HDFC AMC is the AMC of the month. So from that particular company, let's get in one more fund manager. We are being joined by Mr. Shobhit Mehrotra, who is the head of fixed income of HDFC Asset Management. Hi, Shobhit. Thank you so much for your time. First of all, very good afternoon. Shobhit, what we wish to understand is that, yes, indeed, with respect to the bonds, there's a lot of things that are happening right now. What we are seeing is that there is increase in the interest rates that is forecasted. What's your sense on that? Help us in the likely impact on the fixed income as well. How do you foresee this? Because on the one end, the interest rates are expected to be on the rise, and on the flip side, the inflation is also not giving any signs of significant cool off. So, Shobhit, firstly, help us understand that how do you see the construct of the fixed income markets right now?
Yeah, good afternoon. On fixed income, the view on rates is positive. We would expect interest rates to head lower over the medium term. In India, demand supply for government bonds is highly favorable. The fiscal deficit commitment by the government to bring it down to 4.5 by FY26 has been viewed positively, both domestically as well as by foreign investors. There have been massive flows in the fixed income space, 15 billion plus in CY24 because of inclusion in the JP Morgan Global Bond Index. We would expect these flows to continue. Of late, we've seen a little bit impact in the market because of yields rising in the US, because of uncertainty of Trump's 2.0 policy agenda. As markets come to grips with their tariff policy, the impact on growth, inflation of policies set by Trump 2.0, market will get more and more comfort. We would expect eventually US bond yields to start becoming steady or declining, and with that we would expect Indian bond yields to follow. We would expect RBI to consider rate cuts sometime in 25, maybe Feb or maybe even April. But the view is that interest rate cuts have been delayed but not denied. I think over the course of 25, we will see a shallow rate cutting cycle. 25 to 50 basis points is on the cards, and given the positive demand supply scenario for Indian government bonds, we would expect yields to head lower over the medium term.
Right. Now, if you see recently, G-Secs have rallied from 7.3 to 6.8% on the back of the bond inclusion into various global indices. Now, given the down cycle that we are seeing when it comes to the credit cycle and the worries when it comes to global Trump trade, where do you see G-Secs to pan out for, say, at least the next 1 year?
So I think in the current year, the favorable impact has been because of inclusion in JP Morgan Global Bond Index. In FY26, we would expect India to get included in the Bloomberg Barclays Global Index, and that itself could lead to $20 to $25 billion worth of inflows in FY26. So both from FY25 and FY26 perspective, we would expect demand supply to hugely benefit Indian government bonds, and therefore the positive view on rates, on positive view on yields, over the medium term is quite well established in the market, and most market consensus play is for yields to head lower.
Now, if we see the bond market or the debt side of this market compared to equity is still largely unexplored by retail investors at least. But given the fact that we are seeing a rise when it comes to online bond platforms, how have been the flows at your end, at the mutual fund end?
So the flows have not been anything much to speak of. I think the tax changes brought about in the budget last couple of years have taken away one of the key interests of retail in the debt space, especially in the mutual funds. However, institutional interest is there in up to 1 year segment in mutual funds, and we are seeing not much of an impact on flows in that space. But yes, retail has been hit, inflows in that space. We would expect, that to take some more time before retail interest comes back. Obviously, with the other markets, especially equity, doing so well, the entire focus seems to be, more on equity rather than on debt.
Certainly, but Shobhit, also help us understand that what are the key trends that you foresee for the fixed income markets in the next 12 to 18 months per se?
So the key trends, I think, would emerge once in the US we see Trump policies come into play. There has been a lot of rhetoric in the campaign by Trump of imposing very high tariffs, which market at this stage is a little fearful that could lead to higher inflation, maybe delayed rate cuts by the Fed, or rates remaining higher for longer. I think once we get more sense of where the policy agenda is settling down, in pragmatic terms, I think market would get better sense on the growth inflation dynamic, the rates view in the US, and from there, market would get some direction on other places, whether it's other EMs, whether it is on the currency front or in terms of flows. So at this stage, there is a little bit concern of the Trump 2.0 policy agenda, the uncertainty because of that. I think once market gets better sense on where the policy is going to settle down, post that, I think markets would get a better direction, better sense. My sense is that medium term in India, yields are headed lower because demand supply is quite favorable. Fiscal deficit is likely to come down, and therefore there is a lot of demand for government bonds from real money buyers, pension funds, provident funds, and the like. And whether it is FY25 or FY26, we would expect, because demand supply is in favor, yields definitely should head lower.
All right, and also Shobhit, one such trend that we are seeing is that all these green bonds and these ESG bonds are gaining popularity. So what's your view on their potential performance in the fixed income space? Any sense on that?
So at this stage, there have been a few issuances by the government of these green bonds, but there has not been much of a premium or interest from the market. So typically, even though there have been, issuances have happened at a slight premium over the regular government bonds. However, we are not seeing much of a aftermarket interest. The trading volumes are quite thin. At this stage, the demand for such bonds from end investors seems to be quite low, and therefore, it's not been performing as well as one would expect. I think maybe it's early days, as time goes by, maybe over the course of next 6-12 months, if a certain amount of incentives are provided for investing in green bonds, perhaps the demand for these bonds would then improve, and that could lead to some bit of a greenium, which typically the issuers want to charge for issuing green bonds. So at this stage, it's becoming slightly difficult for a government to be able to issue them at better yields than the regular government bonds.
Well, thank you, Shobhit, for joining us and for sharing your perspective on the debt market. With that.
If you like this video, then like, share and subscribe to ET Now.